let's get to Matt McCormick. He's vice president and portfolio manager at Bahl Gaynor. He got his firm out of bank stocks back in August of 2007, of course, before the massive bank sell-off during the financial crisis. Matt, good to have you back here on Street Smart. You know, it is interesting to see this rally at the end of the day. If indeed there's maybe some help for Italy, maybe China, a firm buys up some of those Italian bonds, does it significantly change the European situation in your view?
I don't think so. I think when you look at Europe, you have a series of questions where just the appearance or hint of a rumor propels the market higher into a positive area. And that means as much as a rumor may be or may not be accurately, it could also be incorrect and cause the market to swing the other way. So when you look at these issues, I think ultimately it comes down to logic and fundamentals. And in my opinion, Greece is going to default. And I think when you look at the implications of such, it's the European banks that are going to bear the brunt of it. And then the U.S. banks will also suffer the ripple effects. And that's one of the main reasons why we are continue to avoid many banks, and we feel that there is going to be more volatility, not less, and we cannot advocate owning many bank shares at this time.
Hey, Matt, since we're also talking Europe a little bit, I got your view here. Let me go back to Julie, because Julie, you've been all over Europe today. I mean, you look at some of the different numbers, whether it's the CDS market and so on. I mean, it really is troubling.
I mean, everywhere you look, we're seeing the effect. We're definitely seeing it on stocks, not just U.S. stocks, but the global stock market. The MSCI World Index entered a bear market today. It finished down about 19.8% or 19.2% since we had this sort of uptick at the end of the day. But nonetheless, 20% is a bear market. We're pretty much there. So this already, the fear of contagion is already affecting things to a very high degree. It is happening in the CDS market, where we talked about a 98% probability, according to investors anyway, that Greece is going to default. So, Matt, if the view that Greece is going to default is that widespread, if stocks have already pulled back that much, if yields on European debt are already that high, where is this priced into the market, the scenario that there will be the default?
I don't know if it's priced into the market right now. I think many people are avoiding the inevitable. It's almost like they don't want to drink the reality Kool-Aid. And I think when you look at what's going to happen, if you look at Europe that is either at or near in a recession, a Greek default will certainly push it into a recession, in my opinion. And it's going to ultimately slow our economy more than I think people expect. And so that's why we tend to focus on companies that are more in the needs, not wants situation. In my opinion, you don't need to own a European bank or U.S. bank. And when you look at these companies that many people are focusing at right now, I think there's more risk than reward. And so we advocate not owning them.
You know, Matt, I want to get you to weigh in kind of on the earnings picture here in the United States, because that's the argument we get from a lot of folks saying when you look at the earnings picture, it's still pretty strong. And one individual, I should say in particular, Laszlo Borini, he kind of weighed in on this today. Sheila, walk us through what Laszlo had to say. He's been a bull. He continues to be a bull at this point.
Yeah, look, he's been a stock bull for a while, and one of the main reasons he is because of earnings. Remember, Borini, of course, advised clients to buy in the market before it bought him in 2009, so he's definitely someone investors listen to. And on the earnings front, he says, look, things are looking very good, and U.S. companies, they are just earning way too much to be derailed by what's going on across the pond. So a couple of stats here. He says the companies have been beating earnings for 10 quarters in a row, and despite some of the cuts we have been reporting on, they are still poised to hit record profits this year, around $99 a share for the S&P. You know, he did talk about two very specific examples, Apple and Google. Those stocks have both weathered that recent market volatility just fine. And he actually points out that earnings were the #1 reason. Matt, my question to you is, I know you're a little bit more bearish on earnings. You actually don't think they're going to hold up. Why is that? We are still at record profit levels.
Sure. I think when you look at earnings, and Laszlo is certainly an expert, I tend to look at it from a financial perspective, and the financials are still a big part of the S&P, and I think they're trading on emotion. And the earnings may be great. When you look at last quarter, year over year, they had 16% earnings growth and yet -4% revenues. If you want to get more specific, year over year for Bank of America was up 37% for earnings, yet at 9% for revenues. My point is that people aren't focusing on earnings. They're looking at the contagion effect. They're looking at the ripple effect. They're looking at areas where there is concern. And when you're seeing a risk-off market, people aren't focusing on earnings. They're focusing on principal, downside protection, and income. And I think the financials are still such a big part of the S&P that have yet to go through a rebuilding phase. And I think they still have years, not months, to go through a recovery phase. And that's why we feel the broad earnings picture is going to be much more challengeable. If you are going to look at that from an earnings perspective, look at companies that can make money no matter what and pay a dividend. That's what we recommend.
So you expect us to see earnings revisions here? I mean, we're looking at like $99 and change for this year, well over $100 for 2012, at least as far as analysts are expecting. Do you think that that's going to be pulled back substantially?
Yes, I do. I think when you look at most analyst experts, whether it be top-down or bottom-up, are historically overly optimistic. And I think when you look at what many people believe is we're in a recession in Europe that could potentially slow our economy more, those revisions are not yet baked into many numbers. And I think many people are still overly optimistic about financials. If you look at what's just happened this past couple of weeks, how can that be good for financials? How can that be good for loan growth? How can that be good for capital markets revenues? All of them are going to be weak. And when you look at that type of situation, if you're looking at a positive earnings environment, you have to input a potential haircut in the financials earnings. And if you add Greece and the ripple effect there or Europe, it's only going to get worse, in my opinion.
Matt, let's get to some of the names you like. And I know Altria is one of them. Adam, you've been checking out that one. This is a stock that's actually doing fairly well this year.
Yeah, fairly well. It's up about 6.6%. on the year. It's up today. It goes ex-dividend tomorrow, meaning you got to have bought the stock today if you want to be able to get that dividend. It's about a 41%, or I should say about a 41-cent dividend. So really the question goes out, what other sort of dividend names are you looking at? Because some of the dividend players have really been the place to hide this year.
They've been the place. And when you look at why you buy a dividend, you're buying because companies that have a strong dividend policy usually have consistent earnings and strong balance sheets. We like the other tobacco player, which is MO. You're looking at Philip Morris. You're looking at Altria. We also like Canada. BCE is a Canadian telecom, which has about a 5.7 yield. We do like Selective Financials in terms of the Bank of Nova Scotia, BNS, and Canadian Imperial. One has a 4% yield and one a 5% yield. But I think also you look at needs not wants. Heinz is a situation we like. We like Procter & Gamble as well. McDonald's is one of my favorites. I think when you're looking at an economy right now that has strong dividends, these are companies that don't necessarily offer robust earnings growth when times are great, but they do offer single-digit consistent earnings growth, and they pay you more every year. And I think that's an area where most people are comfortable investing in if they're going to be in equities at this time.
Hey, I got to ask about, I understand the Canadian financials. Everyone always brags about how well they fared compared to our banks that sort of failed. But the Chinese bank, Bank of Zhen, I don't know if I'm pronouncing that correctly. Do you have confidence in Chinese numbers? Do you have confidence investing in that country?
Well, I look at it this way. I have more confidence in Bank of Nova Scotia's executives than I do the Chinese. And they say it's going to be immediately accretive to their earnings. They have a strong history of acquisitions and M&A activity, especially through emerging markets in Latin America and Central America, where I have to believe the economic environment is as challenging. There's no question that China is a growth area. I'm willing to give the executives at Scotiabank the benefit of the doubt because they've had a strong ability to acquire and input these companies into their culture. So I'm willing to let's see what happens.
So, and just to clarify, that's because you mentioned you like Bank of Nova Scotia. They just bought a big stake for our viewers in a Chinese bank. Usually you see that, Carol, the other way around, right?
Yeah, exactly. That's exactly. Hey, Matt, just a few seconds left here. What are you staying away from, just quickly?
U.S. financials, European financials, any companies with large exposures to debt and don't pay a dividend. I think if you're looking at this environment, you want safety, security, and income. If you don't look at the names I recommend, I would look at high-quality stocks with dividends. I think that's a place to hide in this type of environment, and I think it's going to work for the next 10 years.
You're definitely not alone in that thinking. Hey, Matt, thank you so much. Matt McCormick over at Bahl Gaynor.